Hi everybody, I've made this little video to present you the Satyam corporate scandal, and much more precisely to speak about its chairman, Raju. So let's start. In fact, many studies have shown us that the world is constantly going through economic crisis, but it's also about ethical crisis, with corporate scandals, accounting frauds, bribes, and many more. This is the reason why ethics is so important in our world. So first of all, I'm going to explain and highlight the relevant facts of the Satyam scandal. Well, the Satyam corporate scandal is obviously one of the famous and biggest corporate scandals that happened in India in 2009. It's a $1.5 billion fraud. Besides, isn't it ironic that Satyam means truth while investors has been manipulated and bluffed by Raju? So now, let's take a look at the Satyam Corporation. Satyam Corporate was a rising star in the Indian IT services and back-office accounting firm. The company has grown sharply. Indeed, in 1987, there were 20 employees and finished with more than 53,000 employees in 2008. With more than 500 companies as customers and has succeeded to broaden its operations in 66 countries around the world. Satyam was the first Indian company to be listed in 3 international exchanges. The Indian company has established a very good and strong leadership and has gained excellent competencies. In 2008, the company has won the Golden Award for Corporate Governance. But who is Raju? Well, he is the chairman of Satyam Corporate. He is born in 1954 in a family of farmers. He did his Bachelor of Commerce degree from Andrea Loyola College and did his MBA from Ohio University in the United States. He founded Satyam Corporate in 1987 with his brother-in-law and has earned during his career many awards such as the EY Entrepreneur of the Year in 2007 and the Corporate Citizen of the Year Award in 2002. But what happened? Well, it was an accounting scandal. Raju, with the help of the other actors, has falsified the company's account. But how he did it? The 16th September 2008, the Satyam board announced the acquisition of 2 groups named Maitas Properties and Maitas Infra, company owned by Ramalinga's son. Weird, isn't it? He was blamed by investors that he was using their money for the family business which was not profitable. And why he decided to make this acquisition? Well, one of the reasons is that the company has a huge hole in its balance sheet. Therefore, in order to fill up the gap, he decided to make this acquisition, but as we said, this transaction was not profitable at all for the investors. Moreover, he did it to cover his back and hide the irregularities in the accounts of the Satyam Corporation. And what went wrong? Well, he falsified the accounts by raising cash that doesn't exist. He booked bills for services that were never done and have raised sharply the operating profits. On the other hand, the debtors were overestimated by $400 billion and the liabilities were underestimated by $1.23 billion. So, to cut a long story short, all the financial statement of the Satyam Corporation was made up in order to manipulate investors and shareholders. But how he get caught? Well, the 7th January 2009, Raju has confessed that he has manipulated the investors and the global corporate community by falsifying the company's account by $1.5 billion and resigned the same day. He admitted the fraud in a letter addressed to the company's board of directors. He said it was like riding a tiger and not knowing to get off without being eaten. After this confession, the Securities and Exchange Board of India was shocked and scandalized. He was arrested with his brother-in-law 2 days by the police after this confession. He was charged with numerous offenses such as cheating, forgery, falsification of records, criminal conspiracy, and breach of trust. He was sentenced to 6 months in jail. But how the 2 Price Waterhouse auditors missed those $1.5 billion? They obviously ignore evident facts and indication of fraud. PwC was charged to pay $6 million. This event has a huge negative impact on the firm's stock price. Indeed, as you can see on this graph, the stock price has sharply dropped immediately after the Raju's revelation, from 300.10 to 39.95 Indian rupees. Moreover, Satyam lost some deals made with companies such as State Farm Insurance and Bank of America, who decided to end their engagement with the company. Indeed, by such a manipulation, Satyam Company has lost the public trust in the financial markets. The New York Stock Exchange has decided to stop trading in Satyam stocks, and the Indian National Stock Exchange also decided to remove Satyam stock from one of its index. So now that we have all understood that it was clearly not an auditing failure but an ethical one, I'm going to explain the different violations of the CFA Code of Ethics and the Standards of Professional Conduct regarding the Satyam scandal. The CFA Code of Ethics is divided into 6 points. The first component deals with the fact that the CFA members and candidates have to act with integrity, competence, diligence, respect, and in an ethical manner with all the parties and other participants in the global capital markets. Ramalingaraju violates the first component of the Code of Ethics. Indeed, he didn't act in this way with the public, but also with his client and employees. Besides, the two PwC auditors did it as well, but much more regarding their employers and the public. Finally, the internal auditors have also violated this by acting unethically with the other colleagues and the public. The second component stipulates that the CFA members and candidates must place the integrity of the investment profession and the interest of clients before their own personal interests. In this case, Ramalingaraju didn't place the integrity of the profession before his own personal interest when he decided to buy the company of his son. Besides, we can easily highlight that the two PwC was in conflicts of interest and decided to place the interest of their client before the interest of their employer. By doing this, they damaged the integrity of the auditor's company. Besides, the third component stipulates that the CFA members and candidates must use reasonable care and exercise independent professional judgment when conducting investment analysis, making investment recommendations, taking investment action, and engaging in other professional activities. In response, once again, the two PwC auditors have violated the Code of Ethics by making conclusions on the Satyam's account which were obviously made up. They didn't use reasonable care when they conducted their audit and they missed the $1.5 billion. The following point deals with the fact that the CFA members and candidates must practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and the profession. At this stage, we can say that Ramalingaraju violated the Code of Ethics since he encouraged his employee to adopt an unethical behavior. Besides, all the board of directors didn't act in ethical ways when they decided to close the deal without approval of the shareholders. By doing this, Ramalingaraju and the board of directors clearly violate the Code of Ethics. Moreover, the two PwC auditors, by acting like this, didn't have reflect credit on themselves but also on the profession. As you can see on the screen, the CFA Code of Ethics has 2 more points. However, those points were not violated in the case of the Satyam scandal. So now, let's take a look at the 7 standards of professional conduct, and let's see in which way Satyam violated some of them. The first standard is professionalism, and as you can see on the screen, is divided in 4 points. In the case of Satyam scandal, the point A and D has been violated. Knowledge of the law stipulates that the CFA candidates and members must understand and comply with all applicable laws, rules, and regulations of any government. But be careful, in case of ambiguity, you must apply the strictest law. In our cases, Ramalingaraju didn't respect the Clause 49, which has been formulated for the improvement of corporate governance in Indian listed companies. Moreover, the accounting standards applicable in India were not respected. Besides, in this case, all the board members, the internal auditors, and the PwC auditors have violated the first CFA standards. Indeed, they perfectly know that Ramalinga was violating the accounting laws and the corporate governance norm in India. And instead of dissociate themselves, they adopted a passive attitude and knowingly assist in violation. Indeed, by doing nothing, they violated the CFA standards of professionalism. So now, let's take a look at the recommendations. First of all, the board of directors or even the internal and external auditors should have first of all contacted a compliance office to be sure about the way to act, and report the fraud and the violations to the governmental authorities. Indeed, inaction in this case is considered as violations of the standards. Besides, the really and the central recommendation is to educate and keep informed about the law, the standards and the code in order to behave ethically. We can also distribute within the firm the documents on laws and regulations in India. Indeed, we recommend the creation of a code of ethics. Besides, we should implement procedures of reporting the violations, which are anonymous if the person feels unfree to talk. In this way, we will be able to encourage the report of violation. Finally, we believe that peers, before reporting or even quit the company, should first of all talk to their employer and maybe not discussing about the fraud itself, but much more about the way to go through, trying to find the solutions and facts. Saying, look, what we are doing is wrong, but we have to make it right. Indeed, if you look at the background of Ramalinga Raju, he don't have the profile of the unethical person, but he just have the pressure to perform well and to keep a certain level of performance. Solve this problem that became so big and trying to find a way to ethically get out of this problem by saying what it's the right things to do. The second violation is the misconduct standards. This standard is directly linked to the standard A and try to spread it. He deals with the integrity of the CFA's members and candidates. All members and CFA candidates have to respect what we call the mommy rule, which means that act in a way that your mommy will be proud of you. We can easily say that Ramalinga Raju didn't act with integrity. By falsifying the Satyam accounts, he acted with dishonesty and tried to manipulate not only investors but the whole financial markets. Indeed, by hiding first of all his real motivation to the shareholders and by falsifying the accounts, he clearly adopted fraudulent and illegal behavior. By doing this and by involving different companies' members, Ramalinga has discouraged his employees to act ethically in accordance with the CFA standards. Besides, in this case, the internal auditor should not rely on Ramalinga and has to either refuse to create fake invoices and not taking part of this scandal, for instance, either reports this fraud to authorities. These embezzlements has impacted their integrity but also their reputation. In order to avoid this, we recommend to implement a code of ethics to which every employee must adhere, but be careful, as Mr. Tonuti says, it's not only about implement values and codes, but also about the appropriation, the adoption of those values, and to make them into practice for all peers within the company. In this way, we could expect that such actions can be avoided in the future and assure the sustainability of the company. Moreover, by incorporating the values of the company in every act of employees, for instance in every presentation, every discussion, it will be a real solution to clearly educate people to know whether it's a good or a wrong way to work. Integrate value and apply them in the daily work is a suitable procedure than just create a code of conduct and keep it behind the desk. Finally, we can also recommend making background checking procedures in order to find good potential employees. However, even if it seems to be a good procedure, we have the proof with Ramalinga that good background doesn't always mean ethical behavior. Integrity of capital markets is the second standard and it's divided into two subsections, material non-public information and market manipulation. The Satyam scandal has violated the market manipulation. In order to enhance unethical behavior on the publicly traded capital market, the CFA Institute has developed this standard. The market manipulation stipulates that the CFA members and candidates don't have to engage in practice that have to aim to distort prices or artificially inflate the trading volume with the intent to mislead the market participants. Did Satyam scandal violate these standards? Well, yes, indeed, Ramalinga has falsified information in order to manipulate the market participant. He gave a false information through the financial statement and intentionally made omissions of events and accounts. He disclosed incorrect information. He decided intentionally to manipulate the market participant in order to make investors happy by making assets higher than liabilities. His accomplices in the companies have made up fake accounting information in order to mislead the market participants. They disseminate false information in order to increase the firm's value and trigger a market participants to still believe in the value of the Satyam stock instead of revealing the genuine state of the financial statements. Therefore, in order to be sure that the company doesn't hide something to the shareholders and the whole market participants, we should increase the financial accounting disclosure and establish a specific set of rules of conduct for those who are engaging in transactions involving the distribution of information on the market. Duties to clients is the third standard, and it's divided in different subsections as you can see on the screen. The first point, loyalty, prudence and care, has been violated by Ramalingaraju. The CFA members and candidates has to act by putting the client's interests before their own. They should be loyal to them but also prudent and take care of them by taking risk into account. However, Ramalinga didn't act with diligence. He put his interest and the ones of his sons first when he decided to buy the Mehta's company. He didn't act for the benefit of the clients of the company. In this way, we can say that he didn't respect the fiduciary duty, which implies to act in the best interest of another party and therefore act in his own interest. The investment decision of buying the two parts of the companies wasn't made for the client's interests. So now, let's take a look at the recommendations. Fairness with clients and placing the client's interest first is the key elements to respect these standards. Acting fairly is really important. Finally, he should deal objectively with the clients. To do so, we recommend the disclosure of the conflict of interest. Performance presentation has also been violated. Indeed, CFA candidates and members has to ensure that the information is fair and accurate and complete. In our case, the external auditors from PwC didn't respect these standards, and even if they have audited the financial statements of the company, they didn't make any remarks on the 1.5 billion missing. They misstated performance and mislead investors. Therefore, we recommend to require more precise disclosure in terms of clients, sales, and profits. Duties to employers is the fourth standard, and it is divided in different subsections as you can see on the screen. The first point, loyalty, stipulates that the CFA members and candidates have to prove loyalty to their employers. In this case, there is no violation. Indeed, the employees of the Satyam Corporate have made everything to respect their duties to Ramalingaraju. However, the integrity of the capital market has been threatened, and in order to protect the client's interest, employees can use the whistleblowing rule. Indeed, employees sometimes can go against their employers if they saw that they are doing something illegal or unfair. In this special case, a member can violate the fourth standard. In order to avoid those violations, we recommend the implementation of whistleblowing policies. Employees of the Satyam Corporate should have reported Ramalingaraju behaviors to the compliance department or to the manager of Satyam or seek outside advice. Or if it doesn't work, they should dissociate themselves by resigning, and finally, they could report it to the public or to the government authorities or even the press. The following points deal with the responsibilities of supervisors. Indeed, supervisors have to make all they can to encourage the people which report to them to act ethically, complying with the rules, laws, code, and standards. Supervisors are required to influence in a positive way the employees' behavior. They should not adopt a passive behavior which could mean violating the CFA codes and standards. In this case, they did nothing, and even Ramalinga, the big boss, was the main player in this fraud. Instead of conducting the employees to act ethically and fairly, he pushed his employees and a member of the board of directors to act unethically. So now, let's take a look at the recommendations. We recommend the implementations of compliance officer and precise procedure for reporting violations. We believe that supervisor and all employees in India have to be educated and be aware of the importance of the ethical behavior within the company. For instance, supervisors should distribute laws or norms and standards to educate continually the staff. This is for us the main recommendation. Besides, supervisors should have taken reasonable and suitable steps to detect this fraud, but obviously they didn't. Finally, regarding the intern auditors, they should have a regular review of their actions. Standard number 5 deals with the investment analysis, recommendations and action, and is divided in 3 different subsections. Diligent and reasonable basis is the most important in our case. Indeed, the CFA member should exercise diligence, independence, and thoroughness in analyzing investment, making investment recommendations, and taking investment actions. They should have a reasonable and adequate basis for any investment analysis, recommendation, or action. In our case, the PwC auditors has violated these standards. They didn't make reasonable efforts to cover all the relevant issues, and they didn't use diligence. So now, let's take a look at the recommendations. This scandal, and this was the case also with Aaron and WorldCom scandal, highlight the potential alliance between the concerned company and the external auditors. Therefore, we recommend to review reports and pay much more attention to the auditor's firms. Besides, we should establish procedures to evaluate external reports. Standard number 6 deals with the conflict of interest, and it's divided in 3 different subsections. The first subsection, the disclosure of conflict, is the most important in our case. In these standards, the candidate and member has to disclose if there is a conflict of interest, which could impair the objectivity or interfere with the duties to clients or prospective clients. In our case, there is clearly a conflict of interest since Ramalinga Raju aims to buy his company's sons. Besides, there is a conflict of interest since auditors decided to act in the best interest of Satyam Corporation, even if it means lying and hide some information to their company. Therefore, in order to avoid such a problem, Ramalinga should fully disclose the conflict of interest to not only clients but also shareholders and investors by explaining his reasons to make this deal. Besides, in case of doubt, Ramalinga should discuss the issue with the shareholders and expose them to current conflict of interest. Therefore, in this point, transparency is really important. Responsibilities as a CFA Institute member or CFA candidate is the last standard. However, we are not going any further with this point because it's not linked to our case. As you can see, the Satyam scandal has violated multiple standards of the CFA Code. However, after this analysis of the violations of the CFA Code of Ethics and Standards, we still think that in some ways the CFA Code of Ethics and Standards are not sufficient. Therefore, we are going now making some additional recommendations. Indeed, the fair treatment of minority share owners and responsiveness to share owners' concern is one topic which is not included in the CFA Code. With this principle, candidates and members will have to be engaged with shareholders who may have reasonable concerns relating to the company's actions. And in the case of Satyam, we can easily see that the interest of the minority shareholders was not taken into account by Ramalinga and Board of Directors. Indeed, Ramalinga has agreed a third-party related transaction in order to increase the shareholder value, but he did it without taking into account the shareholder advice. The deal was approved by the Board of Directors but without the presence of shareholders. These transactions, they can be characterized as abusive since investors have nothing to say in this deal. The risk to minority shareholders in Asian companies is high since the companies are used to undertake related party transactions. Indeed, to a better understanding, we can take the example of the China companies, where family ownership is something common. Indeed, companies are seeking to undertake such transactions to transfer wealth to the next generation. The first recommendation is that the transaction should be approved by disinterested directors and disclosed to investors in a timely manner. Corporate board independence is also important. In other words, we should give greater duty of independence directors in order to protect the interests of independent shareholders. Besides, we recommend to implement policies to monitor and report related party transactions. Making companies officially responsible in the case of violation of regulations should also be a good way to protect shareholders' interests. Finally, transparency is really important. Therefore, we recommend a higher transparency and much more disclosure about the level of ownership of related parties. As a matter of conclusion, we can say that scandals such as Satyam are really important in order to learn lessons and improve the current way to reduce those frauds in the future. India has experienced significant growth and products become more sophisticated. Therefore, to sustain this long-term growth, the industry must increase investors' awareness and education. To conclude this video, it tends to be important to remind you to keep a critical opinion in any case and ask yourself these questions. Did all the parties got enough power to make a change? Did Ramalinga Raju use his power to force his employees to act unethically? Did he blackmail them? Well, we certainly don't know. But if you were in a Ramalinga's position, or if you were an employee of the Satyam Corporation, what would you have done to avoid all of this? Well, thanks you for your watching.